Good afternoon, dear traders and investors. My name is Sergey. I am Principal Financial Analyst of IFC Markets. Welcome to our webinar. So today we shall analyze the comparative recovery rate of United States and European economies during the recession period. You will be provided with positional trading recommendations, and we will also consider how you can make a portfolio to preserve and increase funds on the basis of American and European assets. We also use an arbitration trade instruments to reduce risk, and we'll also show how you can do it yourself. Classic stock trading instruments have fallen in value during the crisis of 2008-2012. It led to the collapse of hedge funds and banks, not mentioning about individual investors. Forecast errors for the global economy are traditional even for the largest institutions such as IMF. Nevertheless, there are methods that can reduce the number of analyzed factors and overall systematic risks. One of these methods is an arbitrage trading between two assets. Today, we are considering arbitration of two portfolios that characterize the US and the European Union economy respectively. We compare them by the means of synthetic instruments drawn up on the basis of the original GeWorko method developed by IFC Markets. Here we come up with a comparative analysis. We form two indices that characterize the state of the US and the European Union economies, two assets in each one. The selected weights of assets are equal. This is the first hypothesis, which can be further optimized. The American indicator includes Dow Jones Industrial Index and Nasdaq. Dow Jones is showing the movement of stock prices of 30 largest US companies. Two-thirds of them are producers of industrial and consumer products. The second selected component is Nasdaq, which includes 100 US companies of high-tech sector. Weighting coefficients of Nasdaq are determined on the basis of capitalization of companies included in the index. We haven't included the S&P Composite Index in the portfolio, as we consider the companies included in this index to be global companies, and their values characterize the world market demand more than US market demand. The European indicator includes two components at the same weight as well. First of them is DAX, the German stock index. This index includes the value of shares of the companies from various sectors of German economy. The proportion of shares is determined by taking the capitalization of each company in account. DAX characterizes the state of the main drivers of economic growth in the European Union, as German GDP has the highest value among the European countries. Gross domestic product is almost 20% of European gross domestic product. So, lending and investment opportunities of European participants are dependent on the economic development of this country. The second component of the European index is the cost of European currency. This component reflects the attractiveness of the European economy to foreign investment. There are several ways to compare two simple portfolios. Today we discuss analysis and trading with the use of GeWorko method developed by IFC Markets. The point of this method is the expression of one asset value through another on the basis of Forex model. For this example, the expression corresponds to the simplest fraction of relative value of US indicator to the European Union indicator. This ratio, in fact, is based on the crosscars model, allowing comparing two economies and making macroeconomic conclusions. Okay, a relative value of these two indicators can be created graphically in the NetTradix platform. You can download NetTradix via IFC Markets website. You can also apply standard tools of technical analysis to the created chart. For example, here you can see RSI signal line, and NetTradix was used here to form a personal macroeconomic index. This slide represents the daily candle chart of the relative index. This is a personal composite instrument, PCI, expressed as the ratio of the US and European index prices. we define a general trend direction by 30 days moving average and refine indicators using the parabolic and RSI. You can see that first signals of the downward breakthrough appeared in August 2007, when the liquidity of large US banks reduced and the Fed started the supporting campaign. This hasn't led to financial system stabilization, and already in September 2008 problems in the mortgage sector occurred. The relative decline continued till 2009, when QE program was launched and the basic rate was reduced almost to zero. This led to the funds flow into economy and stimulated the export sector. For example, if we look at the technical indicators, we will see that the leading RSI indicator shows bullish divergence in April 2008, and this is the first stabilization sign here. Please note that the relative index has a definite advantage over the analytical index of United States. In other words, it is above the first portfolio expressed in US dollars. It is concluded in reduction of the inflation direct impact on the values of the securities. Indeed, inflation leads to a natural growth of assets that is not always associated with an economic growth. The expression of the asset through the European economy portfolio allows to reduce some impact of this factor. This in turn allows identify the critical moments with higher sensitivity. Okay. Researching the dynamics of US and European economy recovery from July 2009 to January 2014, we can observe the following indicators expressed relative to their values of July 2009. All three macroeconomic indicators for European Union are inferior to the corresponding US coefficients. The alleged gap corresponds to unemployment increase here in both countries. This suggests that the crisis has forced European companies to optimize their activity and increase technological efficiency without attracting a considerable manpower. And this is a positive sign which indicates that European Union has significant potential to compete with the United States. But however, a high unemployment resists still a fast recovery because of the low internal demand. Now we consider each of the indicators separately and compare them with the data on the slide 4. If we separately consider the US indicator, we will see first signals of recession only in December 2007, almost half a year later than in the case of a relative indicator. Thus, the use of macroeconomic index based on GeWorko method could reduce the risks for holders of the US shares and maybe offer them some way to transfer part of the assets in the European funds, for example. On this slide, we represent the European indicator chart built in NetTrading's platform. A slow and unstable economic recovery has begun only in April 2009, and as we see, it came with some delay relative to the beginning of the US economic stabilization. Starting from March 2009 to February 2014, US economy outperforms the European economy. There were two strong upward steps in November 2010 and in August 2011, here and here. Each of these steps is determined by the beginning of a new phase of US quantitative easing program, QE2, that starts in November 2010, and QE3 that starts in September 2011. We can see that each emission package returned confidence to investors and the long-term money market. Let us consider the connection of two economies during the recession and recovery periods. For this purpose, we use a linear coefficient correlation between the yields of two indices. The correlation change corresponds to the range of minus 100% to 100%. Positive and negative values correspond to the forward and backward connection between the dynamics of two economies. The observation was carried out in the period from November 2007 to February 2014. The first factor that is worth to note is that the entire time series lies in the upper semiplane. This confirms the direct technology and investment connection of two developed economies. It is primarily due to the right trade relations between the United States and European Union. In September 2008, the US economy, as we see, became more independent. Here. It happened due to the fact that the crisis has been rising within it. But then a crisis propagation started and the correlation began to recover. The seventh slide shows that this moment corresponds to the recession spread out in the developed markets of the European Union. Finally, it would be worth to note one more dynamic trend from April 2013 here to the present time. The next rise of US economy led to a free money appearance, falling export prices, and that stimulates European economy. Finally, the correlation coefficient increased to nearly 100%. You can see it here. That allows counting on reduction of the risks associated with rapidly spreading processes in world economy. We call them sometimes economic shocks. The decline in the US and European economies in this case will be tightly binded, and their relative changes will be smaller than the change of each index separately. Here we represent a summary table of the characteristics for two recovery trends. Here. The considerable period is March 2009 till February 2014. The third line of this table corresponds to parameters of the relative index that was created using the GeWorko method. The first column shows the average yield of instrument. Based on the principles of modern portfolio theory, we introduced the ratio of return risk, the Sharpe ratio, to assess the asset attractiveness. The risk of volatility is estimated on the basis of return variance calculated for the considerable period. Okay. But as you see, despite the fact that portfolio profitability exceeds US composite instrument, PCI is more attractive for investors because a higher Sharpe ratio is provided. 100% against 83%. So the values represented for the profitability of both indices show that US economic recovery is twice as fast as for the European Union. If a trend continues, the instrument will make an average income of about 0.5% per week with a volatility of only 2%. Okay. Now we can consider the inverse situation and the opportunity to earn in the recession when both indices decrease to our chart from June 2008 to April 2009. In this slide we represented the EU-US inverted index. There is some irony about bullish trading during the recession. If position was opened in accordance with the rules of technical analysis, then the profit would be about 10% in a period less than a year. Statistically, the situation is following. Here we introduce the table of returns, volatility, and the Sharpe ratio of two composite indexes and the EU-US PCI. As you can see, the portfolio pair demonstrates a positive return for the recession period. At the same time, the Sharpe portfolio 3.7% is a lot less attractive than the corresponding ratio for the US-EU, 21% in the recovery period. And during the recession, we can see that the market is more volatile, and we can explain it maybe because it happened because maybe investors are more nervous. Let us consider an example of US-EU composite instrument within the recovery period for daily candles chart. Parabolic and RSI confirm the daily upward trend. This is the main trend. The price ranges above the moving average. Here we use moving average exponential form. We can expect the breakthrough at this level, 1.0154, and further crossing the weekly resistance line. The first target is at 138.2% of Fibonacci level, and we can place a pending buy order above 1.0154 and stop loss below 0.999. Okay. Finally, I would like to give some basic conclusions of our webinar. First of all, we have constructed a relative macroeconomic index US-European Union in the NetTrading's trading platform. The historical data has shown that PCI index is more sensitive to systematic shifts in the world market, and therefore it is more sufficient for analysis and possible forecast. PCI index allows to eliminate an influence of inflation and deflation on the estimating of funds. We have shown that a forecast can be strengthened by a preliminary correlation analysis, and in fact it gives outlining signals about possible arbitrage behavior. A comparison of yield-risk relations has also been shown, and we have found out that PCI is more profitable for investment than single macroeconomic indexes. And finally, a possibility of PCI profitable trading has been proven in the recession period. Okay, dear investors and traders, thank you for your patient attention. Please ask your questions in the comments to this video, as well as through the email. You can see the contacts here. We remind that you can read the analysis of PCI instruments compiled in our website every Friday at 12 o'clock of Central European Time. Goodbye, take care.